Welcome to the deep dive. Today, we're dropping straight into the global internet retail sector, specifically the big players, consumer cyclical stocks priced over 10 bucks. We've got data from a pretty detailed stock screener report, and we're really zeroing in on the top three by market cap. That's Amazon, Alibaba, and JD.com. The mission, quick, crucial insights on how they're performing right now.
Exactly. And it's a fascinating mix, right? You've got U.S. giant Amazon AMZN ticker versus the two big Chinese ADRs, Alibaba, BABA, and JD.com, JDU. It gives us a really interesting snapshot of that USA versus China dynamic in e-commerce. Now, we do need to mention just briefly, this is all based purely on the data we have in front of us. It's for informational purposes, really just a journalistic look. Definitely not investment advice.
Absolutely critical point. So here's how we're going to break it down for you. We'll hit the key metrics for each one: valuation, financial health, any technical signals like potential buy or sell triggers. We'll glance at the recent news and then, do a little paper money math. See how a theoretical $5,000 might have done over the past 6 months. Sound good?
Sounds like a plan.
Okay, first up, the absolute heavyweight. Amazon, AMZN, US-based, market cap, what is it, $2.31 trillion. Just massive. And looking at valuation, the PE ratio is 33.04. That feels high, suggests big growth expectations, right?
It does. A PE of 33 definitely implies the market expects strong future earnings. But look at the PEG ratio. It's 1.74. Now, that's more moderate. What the PEG tells us basically is how that PE stacks up against its expected earnings growth. A 1.74 suggests, the price might be reasonable relative to its pretty impressive historical growth rate, nearly 37% over 5 years. They're paying for growth, but maybe not excessively.
Okay, that makes sense. But the financial health data, that threw me a bit. Huge revenues, sure, over $670 billion. But the liquidity seems tight. Quick ratio at 0.81, current ratio 1.02.
That's a really key insight here for AMZN. Yeah, for a company this enormous, a quick ratio below 1, well, it signals they're running pretty lean on easily accessible cash versus short-term debts. It means they really count on moving inventory fast, which obviously they do, but still, it's a tighter balance sheet from a short-term perspective than you might guess for a $2 trillion giant.
And the news hasn't exactly been quiet for them lately. That big AWS outage, October 20th, right before their earnings call on the 30th, we saw headlines everywhere. Major AI providers, crypto stuff, all affected.
Yeah.
That has to put some pressure on AWS, their main profit engine.
Oh, absolutely. And you see that reflected a bit in the short-term performance, down a bit over the last week and month. Technically, it's dipped below its 20-day and 50-day moving averages, the SMAs, so a short-term downtrend. But, and this is important, it's still holding just above its 200-day SMA, about 1.05% above. And that 200-day line, that's often seen as the benchmark for the long-term health, the bigger trend.
Okay, so short-term dip, long-term trend still holding. But wait, if it's trending down short-term, and they just had this major AWS issue, why are analysts still mostly saying strong buy? They have a target price way up at $265.43. What are they seeing?
Well, they're likely looking at that long-term trend, the underlying strength and stickiness of AWS, despite the outage, and also the technicals. The RSI, Relative Strength Index, is at 43.49. That's technically neutral, but it's getting closer to what traders call oversold. So for some people, seeing the RSI dip towards oversold while the price holds above that key 200-day average, that can actually look like a potential buy trigger. They're betting on the dip being temporary, basically looking past the immediate noise.
Got it. All right, let's do the paper money math for Amazon then. Say you put $5,000 in 6 months ago. Using the recent price, $216.48, that gets you about 23 shares. Cost basis around $4,978. And the performance over that half year, plus 29.38%. Pretty solid.
Very solid, yes. A good steady return profile there. So that plus 29.38% translates into an estimated paper profit of $4,462.67, bringing your total paper value up to $6,440.71. It really highlights what you expect from AMZN. Stable, significant growth, even with some bumps in the road.
Okay, a $1,400 gain is nice, but if we're talking about sheer speed of gains recently, we got to shift to China, look at Alibaba.
Yeah.
Totally different picture here. Much smaller, market cap around $389 billion, and the valuation looks different too.
Yeah, this is where the value argument really shifts. Baba looks cheaper on paper. PE is lower, around 20. Forward PE even lower, near 18. And unlike Amazon's tight situation, Baba's short-term financials look quite strong. Quick ratio, current ratio, both at 1.45. That's very healthy liquidity.
Wow, 1.45 compared to Amazon's 0.81? That's a big difference. Suggests Baba had a lot more readily available cash relative to its immediate obligations. Much stronger buffer. Plus, their growth forecast is huge, right? EPS expected to jump over 35% next year.
Exactly. And the story driving Baba lately seems to be all about AI and cloud. Big push there. There was that news about them drastically cutting back on NVIDIA GPU use, like 82%, using their own internal systems. That signals efficiency, technological independence, things analysts tend to like.
But, I mean, there's always the geopolitical stuff hovering over Baba, is there?
Yeah.
Beijing messing with stable coins, those ongoing U.S. tariff threats that hit all Chinese stocks.
Right.
How does that square with the performance? He said half-year performance was 58%. That's huge amidst that kind of uncertainty.
It is staggering, plus 58.74% in 6 months. And yeah, Cathie Wood's ARK funds have been buying Baba too, adding to the buzz. Analysts are generally bullish, recommendation around 1.36, which is strong by territory. And technically, the chart looks very strong. RSI is up at 56.51, clearly bullish momentum. It's trading way above its moving averages, nearly 39% above the 200-day SMA. That kind of technical picture often suggests strong underlying buying pressure and momentum. The AI story seems to be outweighing the political worries for now.
Okay, let's translate that 58% gain into paper money then. Same $5,000 investment 6 months back. Baba's recent price was $173.47. That's about 28 shares. So that 58% gain turns your $5,000 into what? Over $700? Almost a $3,000 profit.
That's exactly right. The estimated paper profit comes out to a really impressive $2,852.25, bringing the total hypothetical value to $7,710.41. It just shows you the kind of explosive returns possible when you get maybe some fundamental undervaluation combined with a hot growth narrative like AI, even with those significant geopolitical question marks hanging over it.
Okay, so Baba shows the potential upside in China tech right now. But then you look at JD.com. JD. And it really slams home the volatility, doesn't it? Smallest of the three, $45 billion market cap, and recent performance. Really different from Baba.
Yeah, JD it's a puzzle in this group. The valuation is the most striking thing. That price to sales ratio, the PS, is just 0.26. Let's pause on that. It means the market values the entire company at only 26 cents for every dollar of sales it brings in annually. Compare that to Amazon at 3.45, Baba at 2.81. It's incredibly low, suggests either deep value or the market sees significant risk.
And maybe the financials hint at that risk. Profit margin is pretty thin, just 3.06%. Although, confusingly, the future growth forecast is actually the highest of the three. EPS next year projected up over 41%.
Right. It's a contradiction. They're projecting a huge earnings rebound. And the news shows they're trying things like that bid for the European retailer's economy, trying to expand. But just like Baba, they're caught in those same geopolitical crosswinds, the tariff threats, that clearly spooks investors.
And you definitely see that caution reflected in the stock chart. JD's been struggling, down over 16% over the past year. In the last 6 months, basically flat, a small loss. Technically, it looks pretty weak too, below its 20-day and importantly below that long-term 200-day SMA. Bearish signals there.
Exactly. And the real technical point to watch for JD is how close it is to its 52-week low. The recent price is only about, 13% above that low of $29.90. That $29.90 level becomes really critical support. If the price breaks below that level convincingly, that could unfortunately act as a short-term sell trigger for technical traders, suggesting more downside might be coming.
Okay, let's run the $5,000 paper money test on JD's recent rough patch. Using the closing price of $33.76, you'd get quite a few shares, 148 shares. But over the last 6 months, performance was slightly negative, negative 0.88%.
Yeah, basically flat, which translates to a tiny estimated paid-in loss of $123.97. So your total paper value would be pretty much where you started, at $4,952.51. It starkly illustrates that divergence within the Chinese market itself. Baba rockets up on AI optimism, JD treads water, likely weighed down by broader concerns or company-specific issues. High volatility, high specific risk.
Okay, let's try and unpack all this. We looked at three giants in the same sector, internet retail, but got three very different stories. Amazon? Stable U.S. growth, but maybe pricey and facing that immediate AWS cloud issue. Alibaba, explosive recent gains fueled by AI, but always with a geopolitical shadow hanging over it. And JD.com, what's incredibly cheap based on sales, huge projected earnings growth, but performance has been weak and the chart looks shaky.
It's really fascinating how much the where matters, isn't it? Even within one global sector. Look at the beta figures. Amazon's is 1.29. It moves pretty much in line with or slightly more volatile than the overall U.S. market. But Baba's beta is just 0.20, and JD's is 0.43, much lower. That tells you their prices are dancing to a different tune, less correlated with broad market swings, much more sensitive to China-specific news, regulations, political stuff. You saw saw it in the results. Baba's huge gain driven by its internal tech story, JD's flat performance reflecting maybe broader skepticism about the Chinese ADR space right now.
So it really leaves you with a provocative question, especially looking at JD. You've got that rock bottom price to sales ratio 0.26 side by side with this massive 41% EPS growth forecast for next year. Is the market correctly pricing in all the political and regulatory risk? Or is JD potentially a deeply misunderstood, mispriced opportunity? Maybe one that just needs a much longer time frame for that value, if it's really there, to actually play out.
That's the multi-billion-dollar question, isn't it?
Yeah.
Definitely something worth thinking about.